Hello everyone, welcome back to the channel. My name is Gev. It's Monday, June 8th, so let's talk capital. Alright guys, real quick before I jump into it, a quick apology to everyone for not posting enough videos last week. I got into a little basketball injury. I wasn't able to sit down or work much last week, so barely even looked at the charts myself. But doing much better now, so we're going to grind into it this week and figure out what the hell's happening in the market, why they're moving up so rapidly now. So before we jump into it, actually I want to show you guys the second video I ever posted. I went into a quick detail about why the markets could possibly move up, so I want to go ahead and play that for us real quick before we go into get into detail here. And here we go. Why we're seeing this move higher, and everybody thinks the bottom's in for this crash, and I honestly don't believe it is. Okay, the reason why we're moving higher on that, boy was I wrong, right? S&P 500 and looking more bullish on the S&P 500 than any of the other indexes is for one simple reason. Okay, as we can see, all of these candles, okay, where are the bodies of the candles closed? Okay, they're closed in this range right here, right? Most of the candles have closed in this range. Okay, what does this tell us? This tells us that this range is very powerful as far as the bottom goes, right? And that's exactly what we've seen. We've closed candles here and moved higher. Okay, we closed in 2018 when we had that crash and everybody was calling for a bear market. We closed the candle here, moved higher. Okay, and that's exactly what we're trying to do today. Okay, we close the candle here and we're trying to move higher. Okay, this is on the monthly chart. Okay, so basically what this tells us is they're trying to keep the uptrend alive, right? But this monthly candle is still alive, so things can change. Okay, now with that being played, let's go ahead and go back to the S&P 500 on the monthly level. So now that candle we were discussing is obviously closed 2 months ago. I don't remember if we went into detail about this candle, but this candle turned out to be a very pivotal candle for us on the monthly level. So we're going to go ahead and jump into it now as to why this candle meant so much. So basically the situation goes as this, guys. Whenever you hear someone in trading tell you to zoom out or look at the big picture, they don't mean take your scroll wheel and zoom out and look at all the price action forever. What they mean is go from the smaller time frames, 4-hour, 8-hour, 12-hour, daily, 3-day, weekly, all the way up to monthly, possibly even 3-month candles. Okay, why do we do this? Okay, so look, the monthly candle gave you a hell of a situation, right? So what did this monthly candle that we were discussing in that second video I ever posted come down to is this. We had a massive drop 3 months, right? So it started small, got bigger and got bigger, right? So the momentum to the downside was picking up steam and we were hitting levels where we should not be hitting. Okay, so look, textbook, this is what I've been taught, this is what I've learned, this is how the trading game plays out. Okay, so textbook bear market begins after a 20% decline. Okay, this is how it's always gone. Okay, so now here's the situation with that situation. You're gonna look at this chart and you're gonna be like, oh well, Gev, we had a 22% decline here. How come this wasn't a textbook bear market? Well, this is because we were already in a bear market here, right? So you don't get out of a bear market until you set a new all-time high. Your new all-time high was set here. So that means any one of these pullbacks being over 20% would cause problem, right? But they all the way up until Trump getting elected, we have not had these situations, right? Until just about here. And even this one, we just nicked it, 21%. Technically, yes, but you want to see something greater, right? You want to see this. You really want to see this. 36%. This is a textbook bear market. Now, what stopped this bear market? Okay, we discussed it in that video. This uptrend was kept alive on the monthly level, right? So we zoom out and we look at the bigger picture. On a monthly level, we were still bullish. This is what we missed, plain and simple. Okay, now why did we miss this? Because we were in the middle of this monthly candle. So what this monthly candle did right here was engulf the previous monthly candle. What that basically means is you wrap your arms around the previous month with this candle as you did. Look, we opened lower and we closed higher than the body. The wick here isn't important. The body is what's the meat and potatoes of the situation. All right, we opened below and closed above the body. That's a textbook engulfing pattern. Engulfing pattern leads to exactly what the hell we're getting here. Now, another big thing is most bear market rallies end at the 21 moving average. We are clearly above that, right? If we go back and look, we had a drop and the rally ended at the 21 moving average. Drop, rally ended at the 21, rally ended at the 21, rally ended at the 20. We are clearly above this. And not only are we above it, we are getting ready to put down a pattern that is super bullish, and the pattern is called the 3 rising knights or 3 white knights. And that's pretty much 3 very solid body green or blue bullish candles moving upwards. And if this is happening on the monthly, this is very bullish. And in this scenario, we would look for a pullback to about the second body candle, right? So we would look for a pullback, sorry about that, to roughly about right here. Okay, now the greater question is, how the hell is so much negative news driving this market higher, right? We had a small uptick in people being employed last week. We had 1.3 million unemployment claims. We had 2.5 million re-employments, people getting re-employed. If that's a word, I hope it is. If not, I just made something up. But you guys get what I'm saying. We had 2.5 million become re-employed. We had 1.3 million become unemployed. So technically, we had 1.2 million new employments in America last week, right? Now, for some reason, the market took that as a super bullish situation, right? And just to put that into context for you guys, last year when we were trading at the exact same price, unemployment was at 3.1%. Today, we're trading at the exact same price. Unemployment is at 13.5%. Okay, so a full 10% higher, and the market considers that bullish. It's fine. Why does the market consider this bullish, guys? One simple reason. The one thing we completely discounted and neglected to even talk about or mention, and it's completely my fault, is the Fed. Simply put, it's the Fed. So when the Federal Reserve is consistently behind a rally, consistently printing money, consistently stimulating the market, consistently dropping interest rates, okay? What we've learned now is it is foolish to be bearish unless we see a massive break of structure, which is basically insane. Okay, at least from a logical standpoint, to me, it is insane. Because what that basically entails is for us to be bearish, okay, we would have to crash down, recover, okay, and now this would have been the critical test to stay under structure, okay. This would be a psychotic situation, right? Because you have a massive crash, massive rally, to only get to resistance. Basically, this would be something like this. We would come up and mark a situation over here at the X marks the spot and then crash, right? I mean, for lack of better terms here, the Fed is holding up the market. There's nothing else to say, which is fine. I mean, if that's what the market wants to do, we just have to be ready for it, right? So now, with that being said, what this comes down to is with new information comes new light, right? So we can't continue to be bearish while this market runs up. That would be completely insane, right? We have to change as the market changes. As the situation changes, we need to adapt. Okay, so this is what this comes down to. So now, am I telling you to jump in the market right now? Absolutely not. The last thing you want to do is get into a market as the market is moving higher. Okay, that is the stupidest thing you could possibly do. Okay, what I'm telling you is this. We are now completely neutral. We're not bearish. We're not bullish. Okay, I'm neutral. I'm waiting to see what happens on the next pullback. There will be a pullback. Okay, it's just a matter of when. And that pullback will determine how the next 6 months of this market cycle continues. Okay, will we continue bullish and set new all-time highs, or will we hit a double top or something like this and trend back down, right? We have to see. But this next pullback is going to be what is the crucial factor in the next 6 months, right? So if we now it's about how high can we go, and then what happens when we continue lower, right? So now if we go down on the lower time frames, our next pullback should stop somewhere in this range, right? We want to pull back to stop in this range. Why do we want that? Because we would set a higher low. So we have a low, and we would set a higher low here. More importantly, we would hold critical levels that we've not battled through, right? So we had a gravestone doji here that signals a reversal, but we broke above. And I said once we break above the wick, you're going to see a powerful move up, and that's exactly what we're seeing, right? But now the important thing is on a reversal down to hold these levels. Hold a 21 weekly moving average, hold a 21 monthly moving average, at around 3,000, and also the daily 200 moving average sitting at 3,000. It is going to be key to hold these levels so we can further move higher. So that's basically it. The next pull down is going to determine how the market proceeds in the next 6 months. Okay, and one major thing for why I was so bearish back then in March, late March, early February. I'm sorry, early April, was simply this, guys. This is a 90-year historical chart going all the way back to January of 1928 on the S&P 500. So as you guys can see, we've seen massive moves up to the up. Jesus, I can't talk today. Massive moves higher to the upside, right? So as you can see, volatility has dramatically picked up since 1994, both upside and downside. We were not seeing massive rallies like this previously, and most of this comes down to the Fed slowly and more heavily stepping into markets, providing liquidity, providing interest rates, and providing quantitative easing in forms of stimulation, buying of bonds, just all kinds of monetary stimulation for this, right? And the reason why the spikes down are getting more volatile and more dramatic is because traders are becoming more and more scared of this rally because it's been going on for 11 years, right? So now on every move lower, things become more violent and the Fed needs to step in. And the reason why we've now seen two of these V-shaped recoveries almost, remember the NASDAQ has already experienced its V-shaped recovery, setting a new all-time high. The reason why we've seen two of these now, and these are very rare, you do not get V-shaped recoveries very often in markets because it just doesn't happen. And remember, a V-shaped recovery isn't this. Okay, V-shaped recovery is a swift drop followed by swift recovery to an all-time high. Okay, so we had one here and we're having one here. Okay, and the reason why you're seeing this is because the Fed is stepping in and providing liquidity at a very constant pace. So basically, anything being sold is being bought by cheap money. So that's the battle the bears are facing right now. Is the bulls have so much backing that they just continuously keep grinding higher. Okay, so that being said, like I said, the next key things to pay attention to the S&P 500 for a long position is when the rally stops here and when the correction stops. We need to be able to stop at this range of support. If we can get that, we are poised for a solid move higher, probably closing out the year around 34.50 if and only if we can sustain a higher low on the next pullback. So that's what we're watching for. As always, thank you for watching, guys. Please like and subscribe, and I'll see you guys in the next video.